Welcome to the deep dive. Today, we are opening the vault on what is really the absolute foundation of investing. It really is. If you're preparing for a client meeting, managing wealth, or, just trying to be a smarter investor yourself, you have to master asset classes. Our source material today actually calls this the most important foundation.
That is the perfect way to put it. I mean, think about it. Any pound, any dollar that's invested in a pension, a savings plan, whatever, it has to belong to one of these core categories.
Right.
And our mission today isn't just to, list them. It's to really get into their characteristics, the risks, and the strategic role they play.
Because the core principle here, the thing we really need to get across, is that there's no single best asset class. They all act differently. They have their own strengths, their own weaknesses. And confidence in investing really just comes from understanding the purpose each one serves, and then matching that purpose to what a client needs, their goals, how much risk they can stomach, and so critically, their time horizon.
It's like building a house. You don't use concrete for the windows and glass for the foundation. You have to know what each material does and, maybe more importantly, how they all react when the economic weather changes.
Okay, let's unpack this. We have to start with the simplest, most familiar building block, cash.
Right.
So this is your bank accounts, short-term treasury bills, money market funds, that sort of thing. What's the undeniable upside of holding cash?
Well, it provides absolute stability, perfect liquidity, and security. It's non-negotiable for emergency funds.
Instantly accessible.
Instantly. And for any goal you have that's, say, within the next year or two, you know exactly what you have and you can get it right away.
And what's the trade-off? Because if stability was the only thing that mattered, we'd all just use savings accounts and be done with it.
The trade-off is growth, or maybe more accurately, the silent erosion of its value, cash. It just rarely provides any meaningful real return.
And inflation just eats away at it.
It quietly erodes its purchasing power. That's the key. If inflation is running at, say, 3%, and your cash is earning 0.5%, you are losing 2.5% of your wealth every single year.
It's the cost of that security. So the simple takeaway here is cash is essential for safety, but it's a drag on long-term wealth creation.
Exactly. It stabilizes the portfolio, but it can't actually grow it. It protects your capital, but you need other assets to actually build it.
So, okay, from cash, what's the next step up? That's got to be fixed income, or what most people just call bonds.
Right. And these are essentially loans. You're lending money to an entity.
Could be a company, could be a government.
Precisely. To a corporation, those are corporate bonds. Or to a government. In the UK, for instance, they're known as gilts. And in return for your money, you get regular interest payments. That's the fixed income stream.
Okay, so they're generally seen as lower risk than equities, kind of that middle ground. But they're not static, are they? They fluctuate. And this is where it gets a bit technical, with that inverse relationship between bond prices and interest rates.
That mechanism is absolutely fundamental. And it's fascinating because it seems counterintuitive at first. When interest rates in the economy rise, the prices of existing bonds tend to fall.
Which sounds completely backwards when you first hear it.
It does. But think about it. If new bonds are being issued today at a higher interest rate, the older bonds that are paying a lower rate, well, they become less attractive on the open market.
So their price has to drop to make them competitive again.
Exactly. To compensate for that lower payout, this means bonds are really sensitive to what central banks are doing. And for our listeners, the key term here is duration.
Duration.
It's just a measure of a bond's price sensitivity to those interest rate changes. A bond with a longer duration is going to be much more volatile when rates move.
So given that volatility, why keep them in a portfolio? I mean, especially when yields were so low for so long, why not just go for high dividend stocks instead?
Because they provide such an essential structural benefit. They're not just for income. They are a volatility shock absorber.
A shock absorber, I like that.
During a recession or a market panic, when stocks are tanking, investors often flood into government bonds for safety. That pushes their prices up.
Ah, so there's a negative correlation. When one zigs, the other zags.
Exactly. It helps smooth out the overall ride of the entire portfolio. For a client who's, say, close to retirement, having a good allocation to bonds means they don't have to sell their stocks at the bottom of a crash just to generate income.
It gives them balance. It moderates the journey. Okay, so that brings us to the engine room, the real engine of long-term growth, equities.
This is where wealth is traditionally generated, absolutely. When your clients buy shares, they become part owners of a business. They're sharing in the profits, the expansion, all of it.
And the historical record is pretty clear on this. Over the long haul, and we have to stress, long-haul equities have delivered much higher returns than cash or bonds.
But we immediately run into the flip side of that high return potential.
Volatility.
High short-term volatility. Equities can shoot up or fall drastically based on market sentiment, global events, even a single bad earnings report. This is what generates the most anxiety for clients.
So how does an advisor manage that? It's not just about owning stocks, is it? We need to talk about the different types of equities.
That's a crucial distinction. Not all stocks behave the same way. You have growth stocks, companies expected to grow really fast, often reinvesting all their profits.
And then value stocks.
And value stocks, which are usually more mature companies, maybe trading for less than they're worth and often paying dividends. Then you have large cap versus small cap firms. All of these perform differently depending on where we are in the economic cycle.
The strategic insight here seems to be that for long-term goals, like retirement, you have to have equities.
Yeah.
But how do you poach a client through that very real volatility?
You focus on discipline and time. We have to emphasize that these temporary drops are normal. A client saving for retirement in, say, 25 years has so much time for the market to recover from any downturn. Their allocation has to be high because they need that growth to beat inflation and hit their goals.
Okay, that brings us to the more specialized asset classes, property and alternatives. And these really behave differently from stocks and bonds. Let's start with property.
And when we talk about property in this context, we're not really talking about your own home. We're focused on investment properties, commercial buildings, or things like real estate investment trusts, REITs.
And they offer, what, two main benefits?
Pretty much. You have the potential for capital growth, and you have that stream of rental income.
It's often seen as more tangible, maybe safer than stocks, but there's a huge catch, a major headache that advisors have to explain very, very clearly.
And that primary risk is liquidity risk.
Liquidity risk.
Selling 1,000 shares of Apple takes seconds. Selling a commercial building can take months, sometimes more than a year, no matter what the price is. That lack of immediate access to your capital is a really significant constraint.
And it's also sensitive to interest rates, just like bonds are. I mean, financing costs drive the whole market.
Absolutely. And property values are local. You can have a booming national economy, but if you own a building in a town where the biggest employer just left, your investment is going to suffer.
Right. And then we have alternatives. That's the complex sort of catch-all category, isn't it?
It's a very broad category, and it's designed for very specific jobs. This includes things like commodities, gold, oil, metals, or infrastructure like toll roads and airports, and even hedge funds.
So why bother with something so complex?
Because they have unique behaviors. The whole point of alternatives is to provide diversification through what we call low correlation with traditional assets.
So they don't move in sync with stocks and bonds.
Exactly. Gold, for example, often rises during periods of extreme uncertainty or high inflation, precisely when both stocks and bonds might be struggling. It's a safe haven.
And for something like infrastructure, which can be locked up for decades, there's another term we should mention, the illiquidity premium.
Yes, investors demand that. They want an illiquidity premium, a higher expected return, as their compensation for tying up money for so long in something that's really hard to sell. These are complex, often expensive investments, which is why you'd use them sparingly.
Okay, let's unpack how all these building blocks actually work together, because this is where the real strategy comes in. We're moving from just defining assets to actually building a portfolio.
This is the value of blending them all together. The goal isn't for every single asset to be a winner at the same time. The goal is for them to react differently to the same economic event.
Can you give us an example of how that diverse reaction creates a smoother ride?
Sure. Think about a recession. Your equities are probably falling because company profits are down, but at the same time, your government bonds might be going up in price as everyone flees to safety. Or, say, inflation suddenly spikes. That could hurt both stocks and bonds, but your commodities, your oil, your gold, they might soar, and that cushions the overall blow.
So that diversity of response is the key. It dampens the extreme highs and the terrifying lows.
It creates a more optimized path. It's about maximizing your returns for a specific level of risk you're willing to accept.
And the time horizon is absolutely central to how we weight that portfolio.
Precisely. A client in their 20s or 30s has decades for their portfolio to recover from a market crash. So you can be heavily weighted towards higher risk, higher return assets like equities. Their goal is maximum growth.
But that strategy completely flips for someone who's, say, 5 years from retirement.
It has to. They need to prioritize stability and protecting what they've built. That means shifting the balance toward bonds and cash to make sure they have stable capital to fund their early retirement years, no matter what the stock market is doing. A portfolio is not static. It has to evolve as the client moves through life.
We also have to think about what the client actually needs from the portfolio. Are they trying to grow their capital, or are they looking for income to live on?
And we tailor the assets to that need. Equities provide growth, but they also provide income through dividends. Bonds offer that predictable contractual income. Property can deliver a rental yield. So you can structure the portfolio to deliver a specific income level without forcing the client to sell assets at a bad time.
And finally, we have to talk about the human element. This knowledge of asset classes, it doesn't just manage money, does it? It manages client anxiety.
And that raises the most important question. How does all this theory translate into better client behavior? During a market crash, an uneducated client sees the total value drop and they just panic.
Right. They hit the big red sell button.
A disciplined advisor can point to the asset allocation and say, look, yes, the equity part is down 15%, but your bond allocation is actually up 3% and your gold is flat. The total portfolio loss is only 7%.
That stabilizes the client emotionally.
It does. It provides a rational explanation for a scary event. And that reduces the temptation to make reactive choices, like panic selling. It reinforces the discipline that was built into the plan from day one. It gives them something to anchor to besides fear.
So we've covered the ground from the protective role of cash all the way to the specialized diversification from alternatives. Asset classes aren't just boxes to tick. They really are the foundation for every strategic decision: risk, return, liquidity, and ultimately suitability for any client goal.
That is the professional's mandate. The goal is not to predict where the market is going next week. It's to master these fundamental building blocks so you can confidently guide your clients through any market condition.
And we learned that portfolios must evolve, and we noted the extreme sensitivity of bonds and property to interest rates. So if we connect this to the bigger picture, what specific sustained economic environment, not just a recession, but a major structural shift, would cause bonds and equities to become positively correlated for a long time, forcing the most fundamental rebalancing of almost every asset class we talked about today? That's something for you to explore on your own.
A fascinating challenge to consider.
Thanks for diving deep with us. We'll see you next time.